Hello everybody and welcome to the channel. In today's video we're going to be talking about how to never fall for another bad YouTuber stock recommendation ever again. Now it's going to mean you're going to have to learn some boring financial terms and it might be a little bit difficult, but that's the price you have to pay. You will have to learn a few basic accounting principles, basic accounting terms, if you never want to fall for another garbage YouTuber stock like for example Tattooed Chef or anything else. So to start our journey, whatever you have to do, bookmark this site, stockanalysis.com, and through this video you're going to become very familiar with this website. So to start off here, we have a YouTuber stock recommendation. Frankly, I don't get why people follow YouTuber stock recommendations so much. I mean, YouTubers are known for running scam sponsorships like Kamikoto knives and established titles, right? So if YouTubers in their own field can't choose good sponsorships, what makes you think that they're good at choosing stocks either? It's amazing. But anyway, I digress. So anyway, find this website, stockanalysis.com, and here we are right now on a YouTuber stock, ChargePoint Holdings, CHPT. This is an electric vehicle charging network solution in the United States and also internationally. And so anybody who's watching this stock, they would think, well, electric cars are the future. It makes sense to invest in the charging stations. You make money every time someone charges up their car. And so if you're a stock noob, you'll see things like, this stock is cheap. It's only $6. I can buy a lot of shares. Not realizing that, for example, if you put $10,000 and buy a whole bunch of shares at $6, it's the same thing as if you put $10,000 and buy it at $60 per share. You still have the same amount invested, it just changes what number of shares you have, which isn't important. But anyway, the first thing I like to do whenever I find one of these YouTuber stocks is I like to go to the max chart and oh, surprise, surprise! This thing was a hype stock in 2021 when everyone was crazy about EVs and Tesla. And ever since then, all it's ever done is lost people money. Even from inception in 2020, it's lost investors almost 40%. But looking at the peak price of $46 down to $6, we're talking 80 to 90% lost just on this stock alone. So when you look at the past of a stock, you have to realize, has this company ever succeeded at making money for its investors? And then if the answer is no, you have a long shot at success. Everything is against you. So let's dig into the financials. A lot of what gets people tricked by YouTubers is they say things like, look, the revenue's growing. And it is. This company's revenue is growing sometimes almost 100% a year. 60%, 50%. This company does a good job of growing its revenue. But there's more to this story. Going back to the overview page, oh, surprise, surprise. Every time they grow their revenue, they also grow their losses, going from $300 million loss to almost $350 million lost. And that's because as they grow their revenue, they also are growing the cost of their revenue, as in what it costs them to actually produce their products, make their charging stations, and run them. That cost is scaling with how much money they make. So if we scroll down here to something called the gross margin, this is just a term for what it takes to actually make money on their charging stations, as in the literal physical cost of making the charging stations, putting the plugs in, everything else. If this doesn't work, it literally means every single time somebody hooks up to a charging station, their company is losing money. Now, thankfully, this company has a slightly positive gross margin. A lot of YouTubers who recommend stocks that have negative gross margins, meaning that every time someone buys their product, they're literally handing money to their customers and losing money. So let's say, for example, you grew corn, but growing your corn between your tractors and your seeds was so expensive, when you sold your corn, that's not enough money to make up for the cost it took you to make that corn. So in effect, you would be giving your customers subsidized lower cost corn at your own expense, or in this case, the company's investors' expense. So this does have a slightly positive gross margin, which is good, which means that at the very basic level, every time they set up a charging station, every time somebody charges in, they make a little bit of money. But unfortunately, there's more to this story. Look at their operating margins. They are negative, massively negative, getting better slightly, but still massively negative, almost negative 70%, and the same thing with their profit margin. So an operating margin is everything from the gross margin before, but also what's left of their revenue after, for example, the operating expenses. And in operating expenses, all this means is, for example, the cost of their selling, general, and admission. So that means their executives, their offices, their marketing, everything else, and also their research and development. And you can see here, just between their office expenses and the research expenses, that's pretty much all the revenue wiped out just by that. Not including interest expenses, not including taxes, not including everything else. Just from that, they are not making enough money. Because the reality is their margins are so low, the cost of their revenue, they aren't making enough after even setting up the charging stations to pay for just running their business at the most basic level between researching new things and also selling in general and admin expenses. Now, the sad thing is, even if they cut all of their research and development costs to zero, which have been increasing, it's actually quite the opposite, that still would not be enough to make their operating income positive, let alone their net income, which is after interest expenses and also taxes. Another really good way to quickly look at a company and see if it's worth anything good at all is look at the free cash flow margin. This gives you an idea of which way the cash is flowing in the business. Is it flowing into the company or out of the company? If it's negative, that means the company is bleeding cash, cash is leaving the business, and they have to make up for that fact some other way, whether it's borrowing or diluting their shareholders, which we'll get to in a second. And as you can see here, this has a negative free cash flow margin, and despite improving their cash flows after 2018, they haven't done too much to really remedy their situation since 2021. Going back to free cash flow, if a company is bleeding cash to the point of negative 60% on their cash flow margins, how do you make up for it? Either you increase your debt or you dilute your shares. And I think we know which way this is. So if we go here to shares outstanding, all this means is the number of shares they have active on the stock market. I think we see a pattern here. After 2020, right when their stock peaked in 2021 and all the hypey retail investors were getting into it, they flooded the stock market. They sold shares and shares and shares and shares, increasing from, let's see here, 15 million outstanding shares to 356 million shares today. We're talking about that's almost a 99% dilution in your shares. Now let me explain dilution. So let's say a stock is a pizza and you have 10 slices. If you have one of those slices, you have 10% of the pizza. You're pretty happy. But then if I cut up that pizza 100 times, now your single one slice, this is your share, your one slice is now only 1% of the pizza. So it's like if I cut your food down from 10% of a pizza to only 1%, you'd be pretty miffed and pretty angry. It's the same thing with this company. This company dilutes its shareholders into oblivion to pay for the fact that it's losing cash. Going over to the balance sheet now, if we scroll down here to shareholders' equity, if this number is negative, it means that they have more in debts than assets. Then you as a shareholder literally own something that's in the negative. It's like if you bought a house, but you're underwater on your mortgage. Your mortgage was $500,000, but the value of the house is only $250 million. Now, the good news for this company is that in 2020, they had negative shareholders' equities, true, but I think through a combination of raising money through stocks, they do finally have positive shareholders' equity. The only problem is if you were an investor in 2020, you would have been wiped out, which is why the stock price collapsed down from $46 to $6. So now when we look at the cash flow statement, we can see what they're actually doing with their money. So you see here posting a negative $360 million net income loss. You can see here they spend $110 million in share-based compensation alone, and oh boy is that thing peaking up. So you can see here, going back to their income, they spend a fifth of their gross revenue just on compensating people with their stock. Somebody's paying for this, and it's the people investing in these companies because they blindly follow YouTubers and they don't know how to read statements like this. If you go to share-based compensation, you'll see exactly how much the company is using your investments to pay people in their company. You can see here in 2019, they only paid $3 million in share-based compensation, which was reasonable, and now it's $110 million. Now, this can mean two things. Either the insiders, the executives, people in the company are looting it, or they also maybe need to attract more talent, and they do need to pay executives more money. It isn't necessarily a bad thing, but from this company in particular, it looks awful that it went from less than $2 million in share-based compensation to $110 million, a fifth of their just gross revenue. So now let's see what they do with their capital, right? So we have your acquisitions. An acquisition is when a company buys another company, usually to take over that part of the business. It's a good way to expand quickly, right? This company hasn't bothered with any acquisitions since 2020. Now, it's true they made a huge, big acquisition in 2021, almost $200 million. It doesn't seem like they've gotten much return on that. Since 2021, they've been frozen on their acquisitions. They're not using their money for that. Just their share-based compensation the last 3 years alone is as much as their one acquisition, if not more. Now for capital expenditures. If a company's capital expenditures are slowing down, that might mean that the company is just giving up. They're not even spending money on the business because they know it's a fool's errand. The money isn't working very well for them. This company is increasing their capital expenditures, true, going from $5 million to about $20 million, but even $20 million pales in comparison to the $110 million they're paying people in shares inside of the company. So now let's look at operating cash flow, as in how much money is going in or out of the business based on their actual operations, as in running their charging stations, setting them up. Are these things bringing in cash to the company? Or are they causing it to lose cash? And then at what rate? We bring this up, operating cash flow, and you see, whoa, surprise, surprise, they managed to keep it pretty flat up to 2020. Then starting in 2021, when the stock became a hype stock, oh man, have they increased their losses from operations. So even just running their business at the basic level causes them to lose $323 million in cash flows just in the last year, and this number is increasing. So as you can imagine, if a company is bleeding out cash, it has to come from somewhere, and there are two ways here. There's investing cash flow and financing cash flow. So financing cash flow, you can see here, is cash through financing activities. They could be getting dividends or selling shares or changing their debt. So if you remember before, we already saw this company is selling shares like crazy, diluting its shareholders. This is causing them to make some money in return. So some money is coming into the company just at the expense of shareholders. So when you look at something like this, when they have a positive financing cash flow and a massively negative operating cash flow, what this means is this company is being run on the fact that there are always new investors coming in. They take your investment and they throw your investment into this massively unprofitable operating cash flow system, and it just bleeds right out. Money comes in from investors and it bleeds right out. And this is why the share price looks what it does. So when you're looking at this, when you're watching this video, try to remember, when the YouTuber you liked was talking about the stock like this, it doesn't have to be exactly this stock, but a stock similar to it, did they talk about things like this? Did they even look at these numbers? If you have never looked at a cash flow statement or an income statement or a balance sheet, you should probably circle back around, look at those things, and learn what these terms means. And we haven't even looked at the balance sheet today, by the way. If we were looking at the balance sheet, it would give us an idea of how much cash they have versus how much debt, to give you an idea if they can even sustain their debt long term. But that's too short for this video. These are just the most basic things you need to look at to make sure that you're buying a halfway decent company, which would be, for example, the capital expenditure. Are they actually spending money on their business? The shareholders' equity. Are you buying what's the equivalent of a house underwater? Are you buying a company that's the equivalent of a $500,000 mortgage with a $250,000 house? Are you doing that? Gross margin. Is their basic business even profitable to begin with before you count anything, as in actually running, administering the company, or at taxes or anything else? Is the basic product profitable? I'll give you an example. This is the ChargePoint station's gross margin once again. You can see here it is 15%. Now let's compare that to a company like Apple. Oh, look at that. Their gross margin is 43%. So on the basic level, their computers, their phones, their margin, they make 43% on all their products and services. Compare that to somebody like ChargePoint, where at the very basic first step, top of the income statement, they make only 13%. Apple is blowing out the gross margins of this company out of the water. And Apple, for example, has positive operating margins and positive profit margins. Same thing, they're just including more expenses on that after the gross margin. Next up is one thing you should understand are operating cash flows. If the operating cash flows are consistently negative and growing, that means running their business, operating it, just causes the company to bleed out money, and money has to always come from somewhere. It either comes from diluting shareholders, which thankfully doesn't come with much of an interest rate or a debt, or taking on debt to the company, which does have an interest rate and does mean they'll have to pay it off someday. So companies only usually have two ways out, which is either selling what they have, which means shrinking their business, which is not good for a shareholder, diluting their shareholders, or taking on massive debts that have interests and will eventually have to be paid off. At least at the bare minimum, when a company dilutes its shareholders, sure, you lose your investment or you get wiped out or your investment goes massively down, but at least they don't have to pay that back. This YouTuber stock recommendation I found is a trash fire. It is an absolute dumpster fire. We're talking about it's in the middle of a massive growth industry, right? So EVs are all the hype and the craze. EV percentage of the car market share is exploding and going up, and this company can barely run its basic business effectively. So sure, the actual charging stations at a bare minimum are slightly profitable, but their operating margin is massively negative, meaning they can't operate their business at a profit. So until you see something like they actually can figure out how to run their business profitably, which would mean, for example, even if they cut all of their research and development down to zero, that still wouldn't make it. But they have to figure out how to make their operating profitable before this company even goes anywhere. And this is happening in an industry that is booming and growing, where they have all the wind behind their sails, they have all the potential, and they still can't figure it out. And so this is how you identify a YouTube garbage stock. Anyway, check down below. I've got my links to my guide on how to succeed on YouTube, and also my Telegram journal. I post a lot more advanced finance information there, and I will see you in the next video. Remember, YouTuber stock recommendations are like YouTuber sponsorships. Be wary, be skeptical. See you all next time.